Good afternoon. Today is July 28th, 2011, and today I just wanted to go over some of the charts and economic metrics that I look at to assess the health of the U.S. economy and I guess the global economy ultimately. Pretty much my main focus is on the purchasing power of the U.S. dollar and the whole concept of long-term inflation. Since 1971, the US dollar has had no direct link to gold, and therefore there is no restraint on how much money can be put into circulation. There's no restraint on how much can be printed in order to expand credit when they want to put more money in the economy. Essentially, this enables big government spending. This enables the existence of big government in general. It also enables some level of criminal activity, I would say. But I'm not going to get into the details on the whole monetary conspiracy, which is not really a conspiracy, but anyway. Alright, so first thing we're going to look at today is the gold price. We're at 1614. Its high was roughly 1625 and change. And let's look at it for the past, say, since January of 2006. We got that trend going up right there. As you can see, nice diagonal. Biggest dip being, somewhere in '08. And then it resumed its climb up. Based on what I see in 2008, it is safe to say that the next time stocks take a downward tumble, you will see the metals go down. And this is a result of the paper market, because people have short positions in stocks. They decide that they're going to sell their paper positions in gold and silver, put it towards their short positions, cover losses or something. I'm not really that into it. And let's look at it over a longer span. Ooh, that's like a nice steep incline right there. So that's gold right there today. Pretty much near an all-time high. All-time high, not inflation adjusted. This is important. By not inflation adjusted, if you look at the $49, $50 price of silver in 1980, that would be more like $100 or $200 today. People will pretty much argue different numbers on that. I'm not going to get into it. Presently, silver is about $10 short of its 30-year or all-time high or whatever. And as you can see, it took that big tumble there right around the time the Chicago Mercantile Exchange raised the margin requirements on that, on whatever, I guess in this case silver futures or something like that. The next econometric we're going to look at today is actually a pair of econometrics. We're looking at the West Texas intermediate West Texas crude oil price, and that's in the red lines. We got the US dollar index in the black lines, and today we have a 74.239, and the oil price is 97.14 for WTI crude. If we look at this, say, in '06, boom. What I love about this chart is you can see the inverse correlation or inverse relationship between the dollar index, or the purchasing power of the US dollar weighted against other fiat currencies backed by nothing, against something that we consume, in this case oil, that would bring life to a grinding halt in the United States if we couldn't obtain it. So it's kind of important to understand that when the purchasing power of the dollar goes down for one reason or another, it will affect oil price. In the meantime, just something to check out. A good way to see, if oil is up, chances are the dollar index is down. And when dollar index is up, oil might be down too, which is awesome. But, actually wouldn't expect the dollar index to go down based on boom, boom, and loading, please work. Alright, there we have it. I mean, look at that. We're like so close. We're encroaching closer to all-time lows right now. And at that point, I want to steal someone else's terminology on this, but yeah, it's basically a dark abyss of all-time lows. It's thought of another video, so I can't take credit. I don't remember what video I saw, but and then these two little peaks down here. Where did they go? Wait a that's not it. There we go. What is that? Is that fiscal pumping? Is that QE, quantitative easing, money printing? And now the next one, the Dow to gold ratio. Now what is the Dow to gold ratio? Well, first of all the stocks on the Dow Jones Industrial Average are worth 12,240, or the points or whatever, I guess that's the price. Like if you were to price out the individual prices of stocks, this is the number you get. And I see we got a little down 62.44 points, down 0.51%. Suckers. That's why I stayed the hell out of equities. I'm gonna remember now. Dow to gold ratio. It's basically division. I believe it is dividing the price of gold into the Dow Jones price of all the stocks on the Dow. So I guess that would be 1,600 change divided into 12,000 blah blah. And when during the Great Depression, if you ever look at a Dow to gold ratio chart, what you will see is that it's a lower number. Now, what is this number we're looking at? It says 7.62. What this is saying is that all of these stocks on the Dow Jones Industrial Average are worth 7.62 ounces of gold, and that's a relationship because the price of gold went up, the Dow may have gone down. Maybe the Dow gold goes up more sharply and the Dow goes up a little slower. Because you can have the Dow going up and gold going up, and you will be able to see this number going down. We're trending down since 2009. Oh, I'm sorry, rephrasing that. Yeah, since 2009 more or less. I mean, there was a bit of a flat area there, but I mean, this is like before '09. It looks like it came down from something much higher. And there was a time, I think actually in the 2000s or so, or late 90s, you had like 40 ounces of gold to buy the whole Dow, and now we're down to 7.5. During the Great Depression, it was down to like a 1 or a 2. And during the early 80s, it was also in that neighborhood. Back in 1980, when there was like a point in time where stocks really tanked hardcore. Well, the Dow to gold ratio would show that. And so we're coming back down again. And it's an oscillating pattern, of course, as of late, as you can see here. You got this up-down action here. But every time it peaks out and comes back down, it always goes a little lower. And the way I see it's like a 2 or 3 month cycle from what I can tell. Now next week, come Monday, if the Dow goes up or gold goes down, this will actually come back up as it did a few days ago. Just a few econometrics worth checking out. This one here, I pulled up on stockcharts.com, typing $Indu, $gold. And dollar index is available under the instruments menu on silverprice.org or goldprice.org/silver-price.html. And pretty much, if you've seen the dollar index go down, or if you've seen oil go up, this can and does have an effect on other things. And basically, I originally was following the silver and gold just to see as a key inflation indicator. I started following oil shortly after, finding that that's a very good inflationary indicator as well. And basically, I think that right now, the thing that's most important to me is protecting the purchasing power of money that I earn and save. That's about it. No get-rich-quick schemes or anything like that. Although forex speculation seems like a cool little opportunity there. Something to look at. It's also another way to look at the health of our economy is to compare different currencies to each other, or compare different currencies to our currency, and specifically looking at, for example, U.S. dollar against the RMB, the Chinese yuan, issued by the Zhonghua Renmin Yinhang, the People's Bank of China. And that's the dollar against the yuan right there. And this is around the time that China stopped suppressing their currency. I mean, they're still suppressing it, but if they were to do nothing to suppress their currency, it would shoot up. So, very interesting, but there are some fundamental issues and mistakes that China's making. To quote Peter Schiff's radio show yesterday, the Chinese government is making less mistakes than the U.S. government. Good day. Thank you for your time. I look forward to checking back with you guys soon.